Hi, this is Professor Watts from the Institute for Economic Education at East Texas Baptist University. In this video, I'm going to show how to run a classroom pit market to teach students about supply and demand, market equilibrium, and price formation in a fun, hands-on way. Let's get started. Now, this exercise is based on a classic article by Charles Holt, Trading in a Pit Market, which appeared in the Journal of Economic Perspectives in 1996. And if you are planning on running the pit market exercise in your own classroom, I do highly recommend taking a look at this article. It provides detailed instructions, very clearly written, and it's available easily online. If you just Google Holt pit market, it'll come right up for you. But I'll show you here how I do it in my own classroom. Try to keep it as simple as possible, make it fun and easy for the students. Okay, so we start off by dividing the class into two groups of students. One's going to be the buyers in the pit market, the other is going to be the sellers in the pit market. And what are they buying and selling? Well, that's really immaterial. You can just say it's a generic item, commodity X. If you want to make it a little bit more concrete for them, you can give them some little token item. I've given them each seller in the classroom a paper clip, and I'll say this is the item you're buying and selling. What they're buying and selling doesn't matter so much as the process of price formation and equilibrium, which is what we're really interested in observing here. You take the number cards from a standard deck of playing cards and divide them into red and black, shuffle them, and then each student on the buyer side of the classroom is given one card from the red cards. Each student on the seller side is given one of the black cards. Once all the students have their cards, the buyer students and the seller students will then have a chance to find a trade, find a deal with another student on the opposite side of the classroom in what's known as an oral outcry market. Oral outcry markets are not too familiar to most of us, but they are still used in certain circumstances, specifically the stock exchange, commodities exchange, that type of thing. Now, the students have to find a price, and of course that price has to be above the number on the seller's card and below the number on the buyer's card. Because what the card represents for the seller is the cost of producing the item. So sellers must sell the good above the cost in order to make a profit and be successful in the market. The way the pit market exercise is structured, you will not let students in the seller group sell at a price below the number on their card. Likewise, for the buyers, the price has to be below the number on their card. The red number on their cards represents the maximum value for them of obtaining the item, and of course buyers will not pay more than that amount, and so you won't allow buyers in your classroom pit market to transact at a price at or above the number on the red card. Right, and all it takes is two students, one buyer and one seller, to verbally agree to a price, and you instruct the students that once that happens, they approach you at the front of the classroom, and you are there to validate that trade, make sure it occurred within the legal bounds, below the price is below the number on the red buyer's card and above the number on the black seller's card, and you will collect their cards, record their price, and then give them an incentive. Now, we need to give students an incentive to achieve the best possible price, frankly, because the students are lazy and they might not try very hard on their own. So what I tell them is this: we want buyers and sellers to strive for the best possible deal. Sellers want to find the highest possible price, of course, so they can make the most profit. Buyers want to find the lowest possible price so they can maximize the value they get from using the good. So what I do is I just simply tell the students, look, you get the better deal you get, the more reward you get, and that reward is in the form of candy. I have a big bowl of candy up front, and when the students come to validate their trades, I reward them with candy in proportion to their success either as a buyer or a seller. So the way I do this, just to keep it really simple and straightforward, is that sellers will get one piece of candy for every $1 between their cost, the number on their card, and the price that they agree to. And then buyers will get one piece of candy for every $1 between their value, the number on their card, and then the price that they agree to. I should note here that even though Holt recommends 50-cent price intervals, I found that $1 intervals are just easier to handle and work better. So I tell the students up front the prices must be in intervals of $1 whole. So let's look at a quick example of how this works. So say two students agree to a price, they come forward to the desk. I say, okay, show me your cards. Seller student puts down a 4. Buyer puts down a 9. Okay, looks like a good potential trade. Okay, and then I say, what's your price? Students have to agree to this instantly. If they don't, I send them back because they haven't really consummated a deal. But let's say in this case they both readily tell me that they have agreed to a price of 6. Okay, I quickly check to see if that's legal. Is the buyer, the value of 9 on the card here, getting a price below value? Check, so that works for the buyer. Is the seller getting a price above cost? Check. Okay, so that's a legal trade. And then I quickly calculate the reward for buyer and seller. For the buyer, price is 3 below cost, so he gets 3 pieces of candy. So I tell the buyer, okay, take yourself 3 candies. And for the seller, price is 2 above, so I say, okay, go ahead, take yourself 2 pieces of candy. I write that price, 6, at the top of the board at the front of the room, and I announce it to the entire class. Most of the class might be still trading at this point, and we proceed until all trades have been exhausted. Now, in a small classroom, might only take the students 2 to 3 minutes to exhaust all potential trading opportunities. I've validated every transaction. I've made sure the prices are legal. I send the students back to keep trying if the prices aren't, give them their rewards, record all the prices up on the front board. At that point, you'll simply collect back all the cards that weren't used. Some students might not get to trade. Some students might not be able to find a deal, together with the ones that you collected from validated transactions. Reshuffle and then pass out the cards again. Use the same group of buyers, same group of sellers. You'll just repeat the trading round 5 or 6 times. Will usually be all that's required to observe the complete price formation process, which at the end of the exercise I always review on the board and plot it out, so we can observe how price developed moving from round 1 to subsequent rounds. Okay, so with that being said, let's take a look at the pit market in action. This is a video taken in my principal's microeconomics class at East Texas Baptist University just a few weeks ago, this spring semester 2015. Let's take a look.
He's got lower than 5. Lower than 5. 3. I see a 3. I see a 3. You want to do 4? You want to do 4? I got 5. That's all I can do. You win and I win. It's a win-win. It's a win-win. Win-win? Alright. Excuse me. Go. Anybody got 2? Anybody got 2 over there? $2. Anybody got $2? 2. Look for 2. Number 2. Number 2. I got 4. I got 2. I got 2. I got 2. Okay, let's go. Who's got 2? I need 2. Who's got 2? I'm looking for a 2. Who's got a 2? I need a 2. 2. Somebody's got a 2. You know what? I'll sell for 4 when you
I've got 2.
Hey.
Okay, so we just watched a few clips of the actual trading that happened in the classroom. Now, what I've done is plotted the actual result here in the graph, grouped by round. What we can easily observe here is a pattern of price quickly converging to an equilibrium after only a few rounds of trade. So what's happening here in round 1? Notice we have a wide dispersion of prices, as high as $10, as low as $3. And that doesn't seem to be a very consistent pattern. The students are by default inexperienced traders, and they're not trying very hard to achieve the best possible price, maybe giving up too quickly, settling for a maybe not so good deal. Note that after we repeat the exercise only once, the range of prices shrunk quite a bit. Okay, maximum of 8, minimum of 3, and then when we repeat again, we see that the range of prices shrinks, and then by the 4th and 5th round, and as I said, you won't need to do this more than 6 rounds in my experience to get a very tight range of prices, which of course is centered around the equilibrium which our expected equilibrium in this market is going to be right about $6. And notice that most of the trades, or half of the trades by round 5, indeed occur at equilibrium. And we've only got a price range of plus or minus $1 either side of equilibrium. When we plot these results on the board, it becomes really clear visually to the students what's happening here. What's happening? The market is reaching equilibrium on the basis of the competitive actions of buyers competing against other buyers to find the best deal, and sellers competing against other sellers to find the best deal for them. The result, of course, as we're all well aware of, is the emergence of an equilibrium price in this market. And that's really the main lesson from the pit market. Students just simply, by participating as buyers and sellers, get to observe price formation and convergence to equilibrium. We can put special emphasis on the fact that none of the students up front knew what the equilibrium price would be. None of the buyers knew the values for the other buyers. None of the sellers knew the values for the other sellers. And of course, buyers didn't know seller costs, sellers didn't know buyer values. Okay? So each student, only acting on the basis of his own information, participating competitively in this process, generates an outcome which inexorably tends toward a pretty predictable and stable equilibrium. Right? The beauty of the market process at work. I add one wrinkle to the pit market which I think really helps nail down this idea for the students, and then connects the concept of price formation in the competitive market process back to a toolkit that we all probably rely on heavily in our principles classes, which is the supply and demand diagram. So at the very end of the exercise, once we've plotted out the prices by each round, I like to just go ahead and order the cards for the buyer cards demand from highest to lowest, and for the seller cards from lowest to highest. I tape them up in descending or ascending order on the board. So starting with the highest buyer card, and then moving incrementally up in quantity, I place them at their corresponding line on the graph representing the price or the value. And then I literally tape these to the board in descending order in this fashion. And likewise with the seller card, starting with the lowest and moving incrementally up, again placing them at the corresponding level on the chart. And what we get is something like this. In fact, these are the exact cards I used in my most recent example that we just saw the video of. And here you can see the actual result, a little bit sloppier on my whiteboard in the classroom, but you get the picture. And of course, what this does is allows us to connect this idea that the price converged towards equilibrium with the concept of equilibrium is, of course, where the supply and demand curves cross. And I simply ask my students if this looks familiar to them. What are we looking at? Supply and demand curves. And of course, as you heard, the students correctly identify this as the demand curve. Here we've got the supply curve. And we, of course, easily see that equilibrium is going to occur for us right about where supply and demand cross. And there you have it, relating the price formation process, which we participated in and observed in the pit market, back to the supply and demand concept. So at this point, hopefully the students have a very intuitive grasp on what exactly supply and demand curves mean. They have lived it out, so to speak, through participating in an actual pit market. So there's a lot more you can do with the pit market, and I do encourage you to check out Holt's article, and he has some wrinkles where you can involve price controls and taxes. Of course, you could also, if you wanted to extend the application, just simply move the supply and demand curve up and down and show the students that, of course, equilibrium price would change right with it. But for me, this is just a solid, simple tool to help students understand price formation and why we get to equilibrium in a supply and demand situation. So thank you for watching. I hope you found this useful, and I strongly encourage you to take advantage of the pit market exercise in your own classrooms. It's a fun tool that students really enjoy doing, and it's a tremendous aid for them in grasping one of the most important concepts in all of economics.